Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Peloton. So Peloton announced results last week and the stock meaningfully sold off. So we're going to talk about some of the thoughts that I had, and we're going to talk about what investors should think about right now about this investment, okay? So one of the things I wanted to highlight is that the stock meaningfully sold off, okay? You can see that since the start of the year, investors have wanted to do very little with Peloton. You can see that the stock, even before the meaningful sell-off, was already down close to 30% in 2021, okay? So a few weeks ago, I'd written an article about Peloton with the title, "I'm not jumping on this bike," where I concluded saying that I know the Peter Lynch argument quite well, and that makes super sense, invest in what you know and like, but paying 5 times sales for a business with 30% gross margins does not appeal to me. And yeah, I mean, this is ultimately what happened was that they put out some guidance for this year to grow at 14% year over year. Now let's go back 90 days before, and they were expecting to grow in fiscal 22 at 33%, okay? So approximately 800 to a billion in revenues just evaporated here. And this has dramatic implications to what investors are thinking about the growth rate as it exits. Now let me just remind you a few things here. For Q1 22, they put out 6% year-over-year revenue growth rates, and this was largely to be expected. Remember, Q1 of the previous year was particularly strong, so anytime the Peloton was going to come up against that, I mean, it was always going to be challenging for them, and nobody had a large expectations from that perspective. What really dramatically has changed is what is the growth rate going to be? What's a sustainable, steady, consistent, predictable growth rate for this company? And that's really where this boils down to, because investors were just like, okay, yeah, this is a growth company. You got all this connected subscription services, and we're willing to disregard that the bikes are really not carrying very much their weight in gross margin profiles, but we're kind of attracted to the subscription side of the business. And as it transpires, the growth rates are simply not there. And what they try to do is that they try in the quarter to bring down the price of the bikes to reach a wider audience. And they said, okay, part of the reasons that things have affected us is down to the supply chains. But that's really, the topic that's affecting loads of different companies. But specifically about Peloton, it's really that the demand is really like fizzling out. And I mean, it's difficult. And I mean, I don't like to kind of look at these investments, say a negative thing, but ultimately I had been saying for a while now that this is going to be a difficult investment to make. I didn't expect things to go as badly as it did. That's, just to be absolutely clear. But it's difficult, right? So I've been asking this question from investors, from Peloton investors: do profits matter? And I think that yes, the answer is it does matter, because you're looking at a company that's growing at approximately, let's say, mid-teens, let's say 14, 15% year over year. So it's rapidly decelerating, and you're left with a company that on an EBITDA margin for the whole year is going to be negative 6%. So this is it's not a great investment to make, I think. One of the other things that I want to highlight is that sentiment really cuts both ways, okay? So when things are all going well, people are willing to pay very high multiples, the sentiment is strong, everyone's happy, nobody asks difficult questions. And then when things kind of go a bit haywire, as they have done, and people are now, at the start of the year, investors are willing to pay approximately 8 times forward sales. Right now, people are paying less than 3 times forward sales. So with that in mind, it's kind of like everyone's going to be asking really difficult questions from their investment. So as I said it before, when everything is going well, nobody is going to ask difficult questions from your investment. When things go haywire and things hit the fan, everyone is going to be asking really difficult questions, because there's going to be a lot of negative media hitting the company, and it's going to be a case of like, okay, yeah, I bought it what I thought it was cheap, and it gets a lot cheaper. So, I mean, this is not investment advice, and this is just for entertainment purposes. But ultimately, I wouldn't be rushing to buy this dip, because things that are cheap can get a lot cheaper and remain cheaper for a lot longer than you can think of. So with that in mind, the thing that I always say is that don't go for those investments that have a 50-50 chance of working out. Don't even go for those investments that have a 60-40 chance of working out favorably. Go for investments that have a 70% chance of working out favorably, and you don't lose a lot of capital if you're wrong. That's really what you want to work towards. So with that in mind, I'm not going to be involved in buying Peloton, and I seriously think that you shouldn't either. But as I said, this is not investment advice, and if you want to find out what kind of stocks I'm invested in, don't forget to check out my marketplace. It's called Deep Value Returns. I help you think through your portfolio, and you can check out my reviews, my 5-star reviews, see what other people have said about it, and that's a good way to start your research. So with all that, thank you so much for joining me, and yeah, okay, good luck with everything. Bye bye.